Okay, welcome back. We have Ben Powell now joining us, Chief Investment Strategist for APAC at BlackRock Investment Institute. Ben, good to have you with us here. Thank you very much for your time. Let's talk about what's top of mind. Global markets have largely ignored all the fighting around the world, right? And there's a lot of fighting going on. There's Russia, Ukraine, there's stuff in the Middle East, but markets have made new all-time highs. Oil markets have been largely unaffected by all of it. Do you think, we had a one-day large reaction in oil and WIX, etc., in the US because of the Iran missiles. But do you think markets will fade these moves very quickly? Or do you think this is a little different, especially with regards to Iran and Israel? So far, the conflict looked a little coordinated, right? I mean, there'll be some attacks and the other side will attack, provide an out, some face saving for the other side. So there was some element of coordination. This seems a bit uncoordinated, if I can use that word. So could spiral. Your thoughts, Ben?
Hi, Prashant. Yeah, great to be with you. I think, unfortunately, the market is getting used to this kind of event. We've entered a much more volatile environment geopolitically over the last several years. Perhaps that's really a consequence of moving into a more multipolar world, US-China tensions and all of that. And kind of under the hood, what we're seeing is historical fault lines, pre-existing fault lines are coming back to the surface, Russia, Ukraine, Middle East and elsewhere. So sadly, I think this is likely to continue in the years ahead, and we're going to have to deal with more and more of these episodes. What that means, though, as I mentioned, is the market is becoming kind of more efficient at discounting these relatively quickly and looking through them to focus on some of the other obviously very important drivers, be that Fed cutting, be that China stimulating. And for now, of course, the human situation is tragic, but from a market perspective, the market seems to be much more focused on top-line growth globally and by different economies, falling interest rates, and that combination continues to be rather positive for risk for the moment.
Ben, hi, good morning, great to have you on. You actually just preempted my next question because the word I was going to ask you about was complacent. Are markets getting more complacent, ignoring a lot of risks, being at elevated levels? But you said, no, they're actually getting more efficient. So from here on, what would be the key triggers to track? Because your view is quite positive on US equities overall, right?
Yeah, we're pretty constructive. So for the moment, of course, as investors, we're always nervous and anxious about everything. But for the moment, we'd be more nervous about being underinvested than being overinvested. So we'd still be risk constructive, let's say. In the US in particular, of course, we have this artificial intelligence mega force, as we call it at BlackRock, the world's largest investor. And this is really continuing and actually broadening out. So we've seen a lot of the excitement so far quite reasonably has been centered around the foundational technology, the chip makers, the web services, and that's totally fine. But what we think should happen now is a broadening out of some of the excitement into more of the ecosystem, the architecture around the AI. So things like utilities, energy, materials, because for now, AI is still a technology you can stub your toe on. It still exists in the physical world, and it needs, in particular, an energy architecture to kind of feed it the calories to think it's great thoughts. So we are nuancing our AI excitement a little bit and focusing more on that broader ecosystem, critically including energy, rather than just being focused on the big seven, magnificent, no doubt, though they have been.
All right. Hi, Ben. Good morning and good to see you, Ben. This is Nigel on this side. You like the US markets, but what about an emerging market like India? As you've highlighted in your note, demographics are in our favor. Working population will be moving up. We have got earnings growth as well. But at current valuations, is that a bit of a headwind?
I think, look, there's a lot to like in India, as you guys are extremely aware. So the combination of demographic plus productivity gains, digital inclusion, infrastructure, and so forth. I think the big picture in India continues to look very, very favorable, but always there's nuance. I actually think the short-term issue is nothing really to do with India. It actually could be the gravitational pull of China. So China, as we're all aware, India has become recently, a few weeks ago, became the biggest constituent in MSCI emerging markets, taking the crown from China. And that's great, right? We've all enjoyed that. But I do think if China is going to follow through on its stimulus promises, which we may see as soon as next week, it's quite likely that some of the money that global investors have put to work outside of China, be that in other emerging markets or other parts of Asia, probably gets pulled back into China. So I think there might be a little bit of a headwind, really nothing to do with India, but to do with global capital flows moving back into the world's second largest economy as they put their foot on the gas. So maybe a short-term kind of a challenge, again, no fault of India, but to do with China. So a short-term headwind caused by this, but again, from a bigger picture perspective, a lot to like in terms of growth dynamics, reform, and inflation context, which is radically different to where we were just a few years ago. So a lot to like.
Ben, just two questions, and if just want brief answers on these. Running out of time. One is, do you think if you look at over a period of time, when you get when China gets money, emerging market funds get money. History shows that all emerging markets get money. So is it this or that? If funds go into China, does India will it be negative for flows into India? That is one. And second, just to go back to the geopolitics, if over the next, say, 24, 48 hours, oil infrastructure in Iran, within Iran is hit, do you think it will cause ripples and asset markets around the world will react? Go on.
So on the first of these, I think it's both. If I can have my cake and eat it too, I think it is both this and that. So I think in the very short term, you might see a few buying of China funded by not China. So I think that can be a slight headwind briefly. But your broader point is the right one, which is overall, and this is why we at BlackRock are overweight emerging markets strategically, this backdrop of Fed cutting and China stimulating normally is pretty encouraging for emerging market risk writ large. So I think, yes, if the big one, I guess, China within the emerging market framework goes from really being flat on its back, right? Sentiment, positioning, and more broadly, thinking towards China has been extremely negative for the last many quarters. If that perks up, I think you're absolutely right. It should be encouraging for the broader asset class, including India, as an important part of emerging markets. On the second of your question, yeah, look, I mean, for the moment, it looks like this is a relatively, of course, we shouldn't underestimate the human element, that's for sure. But from a market perspective, I think the market is considering this to be something as unfortunately, a normal part of the mood music in the backdrop. Of course, we are all watching the escalation cycle with both eyes. And if it looks like it is starting to spiral and move to a totally different level where perhaps other powers are getting involved, then of course we would need to reassess. So let's see. It isn't that for now. If that changes, we will adjust accordingly.
All right, Ben, we'll leave it there. Good conversation. Thank you very much for joining us, and hope we are able to do this more often. Thank you. And good to have you with us here on CNBC TV 18.